Hello, dear students. I am Dr. Binoy Arickal, Associate Professor, Department of Commerce, Bhopal School of Social Sciences. The main objective of this module is to introduce you to the Depreciation Fund Method of depreciation. Depreciation Fund Method is also termed as sinking fund method. Under this method, the amount of depreciation remains the same for all years. Under this method, every year, a sum equal to the amount of depreciation is transferred to depreciation fund. The main purpose of establishing such fund is to have sufficient accumulated balance which helps in replacing the asset. The amount which is transferred to depreciation fund is invested in form of securities to earn interest. The amount of interest which is earned, that is also transferred to depreciation fund for further investment. This process is continued for all years except for the last year when the investment is sold. Now I will be discussing the journal entries that we pass under this method. At the end of the first year, as I said, the amount of depreciation is transferred to profit and loss account, as well as sum equal to the amount of depreciation is transferred to depreciation fund. For creating depreciation fund, the entry is depreciation account debit to depreciation fund account. Then comes the transfer of depreciation to profit and loss. Entry, profit and loss account debit to depreciation account. As I have mentioned, the amount which is transferred to the depreciation fund is invested in form of securities. Therefore, the last entry in the first year will be depreciation fund investment account debit to bank account. These are the set of entries that we pass in subsequent years. However, entries at the end of the last year will be different. In the subsequent year, the first entry will be the interest which the organization is going to earn. For that, the entry will be cash account debit to interest on depreciation fund investment. This interest has to be transferred to depreciation fund. Therefore, the next entry will be interest on depreciation fund investment account debit to depreciation fund account. Again, depreciation fund will be created. Entry, depreciation account debit to depreciation fund. Transferring the actual depreciation to profit and loss. The entry will be profit and loss account debit to depreciation. At the end of the last year, again, the investment will be made. Entry, depreciation fund investment account debit to bank account. As I have mentioned, for the last year, the set of entries will be slightly different because in the last year, the investment will be sold. First entry for receiving interest, the entry will be cash account debit to interest on depreciation fund investment account. This interest has to be transferred to depreciation fund. Therefore, the entry will be interest on depreciation fund account debit to depreciation fund account. In the last year also, we are creating the fund. Entry, depreciation account debit to depreciation fund account. Transferring the amount of depreciation to profit and loss. Entry, profit and loss account debit to depreciation. As I have mentioned, in the last year, the investment will be sold. And when the investment is sold, entry will be cash account debit to depreciation fund investment account. For closing the asset account, the following entry will be passed, that is depreciation fund account debit to asset account. If the investment is sold at profit, the journal entry will be depreciation fund investment account debit to depreciation fund account. Whereas if the investment is sold at loss, we need to reverse the entry. Entry will be depreciation fund account debit to depreciation fund investment account. In the end, we need to close the depreciation fund account. And for closing the depreciation fund account, there can be some balance either in the debit side or in the credit side. Therefore, the following entry will be passed, that is depreciation fund account debit to profit and loss, or profit and loss account debit to depreciation fund account. The main advantage of this method is the organization need not to worry about arranging the funds in the last year when they are going to replace the asset. As the investment is sold, whatever amount the organization is receiving from the sale of investment, that is used for replacing the asset, which means there is no burden on the organization when it comes to replace the asset. The most important limitation pertaining to this method is if the investment is sold below the market price, the organization do not have adequate amount to replace the asset. That's all from my side. Thank you, students.